Hey, what's up, guys? I got one of my colleagues here, Josh Schoenly. He's actually a Pennsylvania realtor and a lender, and I invited him on over here. He's with a wealth of knowledge, and he's going to give us some information on HELOCs, home equity lines of credit, also a home equity line or home equity loan, right?
Yep. Yep.
And we have some good questions. I had some of my friends reach out a couple of days before and ask me some of these questions, and I'm like, oh, thank you so much for your contribution. I can't wait to ask Josh this stuff
Yeah.
and go from there. This is going to be very good for folks that are thinking of taking some of this interest or the equity, out of their home because everyone right now is equity rich, right?
Well, I would say most folks are, right. I mean, we've had a good run up on appreciation for the last 2 or 3 years, even though it may have slowed a little bit the last 12 months. I would say, generally speaking, especially in the Northeast, it's still been pretty strong. And so I think when you first, reached out and asked me about this, the idea was, or the thing you wanted to clarify, can people really keep their low rate, right? Because a lot of people are locked in at 2.5, 2.75, 3.25, and we're not there right now. But is there a way to tap into that equity without jeopardizing or losing that low rate? And so a HELOC or a HE loan can be a great way to do that. And we can talk about the differences. There are slight differences in the two,
Yeah.
and then give people options for it, if they're interested in exploring, what amount of equity they might be able to unlock, and maybe some of the uses, what they might use that equity for as well, which I know you had some questions on as well. So you tell me where we should start.
Yeah, great stuff. So yeah, what is the difference? Because there's a home equity line of credit, right? A HELOC, which a lot
Yep.
of us are close to used to hearing and saying. And then there's a home equity loan.
Yeah.
Right? Okay.
So So a HELOC, the way I would the analogy or the example I would give for that, it's kind of like a credit card on your home. In other words, you only pay for the balance that is in use. So if you get a home equity line of credit for $150,000, let's say, but you're only using 100,000, you're only paying on the 100. With a home equity loan, a HE loan, they're often also referred to as a closed-ended second, and they're very much akin to a first mortgage. They're just in second lien position,
Mm,
and they have a fixed rate, a fixed term, and a fixed payment.
okay.
So you would have and there are all of the options that you would find on a first mortgage, or most of which they exist on a second mortgage. So you could have a fixed rate 30-year, you could have a fixed rate 10-year, 15-year, you can have a variable rate. There are interest only options.
Mm,
So there are any number of options. The big difference, though, is one is fixed. You know what your payment will be for a specific period of time. The other one, you're paying on what you're using. Now, with either of those options, the rate is going to be higher than a first mortgage. Okay, so just very transparently there. And the rate and term is going to depend on various factors: credit score of the borrower, the amount of equity, or more specifically, the cumulative loan to value. So what
mm,
does that mean, right? That sounds
yeah.
technical. Let's say your house is worth $500,000 and your first mortgage is 300,000, right? So we've got a $500,000 value. We've got a first mortgage for 300,000. That first mortgage is 60% of the value.
Mm,
Okay. 300 out of 5, 3 out of 5 is 60%. Okay. If you want to tap equity and you say, I want to tap, I want to get $100,000, that means that your cumulative, your CLTV, 300 plus 100, we've got 400, house is worth 5, your cumulative LTV is 80%. Now
okay.
you can have a higher than 80% CLTV, but when you do go higher, that can affect the rate and terms. In other words, you may pay more for for that sort of convenience, let's say, or for those, in situations like that, the lender, just by sheer numbers, that they're assigning more risk to that,
Yeah.
right? Because who knows what happens in the world. Over the long term, home prices tend to always win out and appreciate. But in short term windows, you never know what will happen. So when lenders assign more risk to a situation, they're going to require the borrower to pay for it in some way, shape, or form. So it might be increased fees.
Yeah, there's
it
going to
might
be a premium.
Increased
There's going to be a premium one way or the other.
Exactly, right. Yeah. Exactly. Now, you can get a HELOC or a HELOAN on your primary residence, but you can also get them on a secondary or investment property as well. The terms and the rates, etc., are going to be a little bit different, but just want to, open folks' minds to, or open the concept that it's not limited to just your primary residence. And in fact, we have somewhere between 8 and 10 clients right now that we are actively shopping for how to best tap the equity on investment properties. So it's not limited there. I think the big, whether the mechanics of how you can do it, right? I think the bigger thing that I would think about is when you're talking with clients about that, like, what are we going to use this for, right?
Right.
And I would always caution folks to not necessarily use them on frivolous things, quote unquote, but can you reallocate the equity into something that increases your cash flow or decreases your liabilities? So just to get people's gears turning, the clients that we're working with now, many of them are using equity to grow their investment portfolio or start an investment portfolio. Many are using them to consolidate higher priced consumer debt, right? Consumer debt right now, the rate on traditional credit cards or even on a lot of auto loans is really high, right? So looking at your total financial picture and trying to create a situation where you're putting yourself in a better position. Another way that, maybe you have a growing family and you need more room and you don't want to move. You love your house, you love your neighborhood. Another great use is to make improvements or renovations to your existing house. What I caution people against is buying toys or spending it on things where it's lost, right? If you're renovating or making improvements to your home, theoretically you're increasing the value. If you're using it to consolidate debt, that's saving money theoretically, right? If you're using it to grow an investment portfolio or start an investment portfolio, that's helping to grow your wealth or increase your cash flow, or ideally both.
So those are jump in there. Let me jump in with that. That's awesome. So growing a portfolio, starting your own, what you're saying is we're going to take money out of a home that we have equity in, and we're going to use that as a down payment to buy our next property, right?
Absolutely. That's a wonderful use.
And then you also talked about not buying, like, say I want to put on a screened-in porch, right?
Yeah.
Today's world, $50,000-$75,000 doesn't give you much on a screen-in porch. I'd rather not pull that out of the bank account. Some people don't have that in the bank account, right? So if I've got that equity in my home, I can pull that out and use that and improve my home. And so that's great. That's great. So that kind of moves into, let's talk about that. Like, which one should I do? Like, if you're my friend, I'm like, hey, I want to put in a $75,000 screen-in porch. Do I do it a loan or do I do a line of credit?
Well, I would say, I always put it back on, it depends. How long are you planning to stay in this home? Okay. If you're putting that on, you're probably planning to stay there for quite a while.
Okay. Is there a duration we should be looking at? Like, we should be looking at like 5 to 10 years is like a decent amount of time, or like?
I would say so. I would say anything 5 plus, right? And what I would ask for help, right? So get back to Richie and run the scenario. Number one, confirm, is this improvement I'm making, is it actually going to add value to my home? Now, that doesn't mean you don't do it,
Right.
if it doesn't, right? Because it
Right.
may add value to your, your family and their, your ability to enjoy the property, right? It's not always, it doesn't always come down to straight dollars and cents, okay? But
Mhm.
just having an expert opinion there. And then I think things to think through would be, um, is this a single, like, are you looking to use the money one time and be done with it?
Uh,
Or are you looking to uh, maybe use that capital over and over again?
like
So
a
I'm going
rinse
to
and
start
repeat.
by making this renovation. And I know that I've got a windfall of some kind coming in the near future. I'm going to get a big bonus at work, or I'm going to get a big, increase in salary where I might be able to pay that off, but then I could reallocate that to start or grow an investment portfolio or make another improvement to the property in three to
Right.
5 years, right? So we're gonna start with the screened-in porch, and then 3 to 5 years down the road, once we paid that down some, we can reuse it to put in the pool and the a nice
Wow.
outdoor kitchen or whatever, right? So it really depends on the goals of the homeowner and what their what their big picture is. Now, obviously, plans change, things change, etc. And if you really can't decide, that's part of what we do for our clients is let's take a look at this in black and white. What we know today, which could change, right? The information we have today, the rates and the details that we have today, and then create a plan accordingly based upon that.
Awesome. So a home equity line of credit, what it sounds like to me is the rate is always moving. It's variable. It's constantly changing. It's not locked in like a home equity loan. Am I?
They can. Okay, so they you can get a fixed rate on a HELOC,
Hmm.
but what isn't fixed is how much you have in play. In other words, that rate can be fixed, but the interest you're paying is only on the amount of the principal balance per month. So let's say, once again, you may have a fixed rate, but you're only using 50 of the 100,000. So
Uh-huh.
you're only paying the fixed rate on that 50. Whereas if it was a HE loan or a closed end second mortgage, and it was for the full amount of 100,000, you know what your principal and interest payment is each month, right?
Right.
It's a fixed rate. It's a fixed number of years or months. You
Mm-hmm.
know what that is each
Mm-hmm.
and every month, regardless. It's
And I'm
just like
paying,
a fixed 30-year mortgage, let's say.
okay. And so I'm paying interest on that full amount. Where with a equity line of
Exactly.
credit, I'm only going to be paying interest on the stuff I pull.
Exactly.
Wow.
Yep.
Very
Yep.
cool. Good stuff. So the questions that most people are going to ask is how long can they do a home equity line of credit? What fees are usually associated with that? I know, yes, rates are typically higher, but
Yep.
there's usually maybe fees associated.
Mm-hmm.
And then what is the rate? Are we talking
Yep.
1% higher than normal? Are we talking, to give us an average or an
Yep.
idea what those look like?
So I'm gonna do a shameless plug here. If you scan the QR code, that's not that one, but the one over, I don't know, the one on one of the two. If you scan one of the two, the one over here, I can't point to the right way. Yeah, that one over there. If you scan that one, we have an automated online application for what we call our 5-day HELOC, and it takes just minutes, and it's a soft credit pull, so it's not a hard credit hit. And the reason
Mm,
why I point that out now
yep.
is you can see in minutes what the offers may look like
Mm,
for the amount of equity that you can tap into and the different fees and terms based upon that. So that's one of many HELOC options we have. It's just a simple automated online uh, um,
cool.
application process. It's very similar to applying for a credit card or even a car loan, an auto loan. Okay.
Right.
But we have many others as well. So we do manual HELOCs. As far as the costs and fees, we have 5-year terms, we have 10-year, 15-year, 20, 30-year. So it's really flexible as to how you want to break it down. We have fixed rates, we have variable rates.
Mm.
The actual fees of what it will cost you, it's anywhere from 2 to 5%. Okay.
Of
Now,
what? 2 to 5% of the what we're pulling out of
of
the
whatever the maximum amount is. So if you want a
hundred
HELOC of
grand.
Right. It would be, and the reason why there's such a variance there is there are a lot of different factors, and we kind of hinted at this already. The risk tolerance,
Right.
what the combined LTV is, what the credit score or scores are of the borrowers. There are a lot of factors that play into that. But just to give a general idea. Now, as far as rates, on our automated HELOC, it's going to be anywhere from 9 to 12%. But we do have some other options that are more in the 7 to 8% range. And just for context, at the time of this recording,
Yeah.
FHA fixed rate mortgage rates are about 6. You'll find, depending on the day, a little below, a little above. And conventional is closer to 7 or maybe even a little over. So we're not talking about like exorbitantly higher. And once again, what it would, if I were thinking about this, the question or the the important thing that I would think through is, if I'm consolidating debt, is it a net positive, right? In other words, am I in a better position by consolidating this debt with a HELOC versus how the debt is currently structured, right?
Yep.
Or am I going to be using this in a way to increase my cash flow, investment portfolio, et cetera? Or once again, am I going to add value to my home and add value to the experience my family is able to have at the home because of that, right? So it's a balancing act and finding that happy medium for what makes sense and how you want to allocate it and what your tolerance is on the costs and fees associated with it.
Awesome. Okay. So we got length, the fees and rates, and then anyone is out there interested in this stuff. That's why I brought Josh on here. He is happy to talk to you
Absolutely.
and go over this information and run some scenarios. He can help serve here in Virginia just because he's in Pennsylvania. He can definitely take care of all of us here in Northern Virginia that are watching
Yep,
this.
our whole team is licensed and good to go in VA and actually much of the United States, most of the United States actually.
Awesome. And my friend was like, "Hey, well, how do I get the best rate? You know, where is that?" And hopefully Josh will be able to do some shopping and be able to be very competitive. And then should they shop around? And like you said here, they get a soft credit pull, but as people kind of look around and have options, are they getting their credit pulled by different lender after lender?
That's a great question.
Yeah.
Yeah. So one of the reasons why I chose to work with Nexa Mortgage is because we are a broker, and not only that, we work with over 200 wholesale lenders, and then we work with thousands of other private hard money and commercial lenders. Why is that important for the consumer? Whether you choose to work with us or explore options with us, I would encourage you to at least communicate or give an opportunity to a mortgage broker. Why? Because they can shop many, many options for you with one credit pull. One credit pull. Now you can once again, if you use that one, I pointed to the right one. You can see what options are available for you, and it's a soft credit pull. But if you want to really get to work on shopping and finding the absolute best deal, at some point you will need a hard credit pull. But when you work with a broker, they can take that information. It only hits you one time and then go and shop for the best option or options for you. So on the other hand, if you go individually to a bunch of different individual lenders and you're not careful, if you've got multiple people pulling your credit to shop their little retail, loan shop or a local bank, each time that is a hit on your credit, and that can affect your credit, depending on how many. So I would just be careful, and I would highly recommend to everybody listening, if or when you're shopping for financing needs, at least talk to one broker and see what they're how many options they're able to shop on your behalf, because that is one of the biggest value propositions of working with a mortgage broker is those abilities. We're shopping with lenders that are trying to get more of our business. And in particular, Nexa Mortgage, we have thousands of LOs, which means the wholesale lenders that we work with, they compete for our business. And when they're competing, you as the consumer ultimately is the winner because they're cutting better deals to earn our business and therefore your business or the consumer's business.
Perfect. So even if they have a loan now and their mortgage loan now can maybe do a home equity line of credit, it's still maybe a great idea to contact you and do a little bit of due diligence before just sticking with the same person.
It's at least worth a conversation, right?
Yeah.
Because in some cases, that current loan servicing company or lender might have the best option for them. They might.
Okay.
But in some cases, many cases, we find that they don't.
Right.
There are they may be. I'm trying to think of an example. So most businesses have products and services that they offer to get the customer, and then they have products and services that they offer where there's a bigger margin of profit for the business. Yeah. And in a lot of cases, these HELOCs are priced such that those are where they make their margins. And so just be careful, right? Sure. And do your due diligence to make sure you're getting the best deal, and the best rate, the best term, the lowest fees, etc.
Beautiful. And a couple more things here before we sign off. Sure. Do you ask, or does the lender ask why we're pulling? Do they ever have those questions? Because that's my biggest thing. And I know it can maybe get into and maybe not ethical thing, but almost like a loan fraud I'm concerned with is like I've had people take a home equity line of credit and then buy their next primary residence so they're non-contingent on, right?
Which that's a great strategy, especially in a market where we still have very low inventory, right? So you do want to be careful that different lenders have different acceptable uses and so forth. When you check this one out, that one, it's really your equity, it's how you want to use it, etc. But for example, if you're doing a cash out refinance, which I know isn't the topic today, but if you were to explore a cash out refinance, the lender in most cases is going to ask, and you will have to provide an explanation as to why you're doing this. They want to know, is there a tangible net benefit is what they're looking for. Is there a legitimate reason why you're doing a cash out refinance? And there are many legitimate reasons. Yeah. It's just that they want to verify that there is a legitimate reason. And debt consolidation, using the money to invest. I mean, all of those things can be reasonable explanations. Yeah. Where I would be careful in the scenario that you mentioned is there are lenders that have a minimum. There are potentially penalties and fees if for prepayment, right? And so you just want to make sure that the type of, whether it's a HELOC or the type of financing that you're pursuing fits the objective that you're trying to use it for, so that you don't get blindsided by fees or costs that just either weren't explained well enough or maybe in some cases sadly weren't disclosed at all. Right. Well, in today's day and age, it's pretty hard to get away with not disclosing them, but disclosing them in a big packet of electronic files is different than being explained very clearly in layman's terms so that people know what they're getting what they're not getting. Yeah.
That's exactly right. So, and then is this
Richie, one other thing I'll say, it is important that you are transparent.
Yes.
Because if you're not, you can end up with a situation where the loan officer or the mortgage person, because they didn't know, you end up with something that gets you in trouble or creates financial pain. And so as long as it's legal and ethical, just be transparent, because there are financial instruments for just about anything, once again, if it fits the legal and ethical umbrella.
Sure. And is this a tax write-off on my primary residence? I'm pulling out $100K and I'm going to put in a deck, fence, and all this stuff.
So I'm not an accountant, and I don't play one on Zoom or the internet. So I would talk with your accountant. But generally speaking, the interest is deductible. Okay. Generally speaking.
Good. I think we covered anything else you want to add on that I might have missed?
No, I would just encourage folks to at least, if you have a reason to look at how to better leverage that equity that many of you listening to this have gained over the last year, 2, 3, 5 years even, I would encourage you to explore the different options and really sit down and think about how am I going to reallocate that, and where can I get the best deal, or the best rates, fees, etc. You can check out either of those QR codes. The one over my right shoulder, is our 5-day HELOC app. The other QR code is just for our traditional application. You can create an account and apply there. Neither of which will do a hard credit pull. We will always we'll have a conversation with you and get we'll be on the same page before any of that happens. This just allows us to get the ball rolling and see what options we may have for you. And honestly, talk with Richie first, right? And see if it makes sense from the real estate perspective, what you're thinking about doing as well.
Beautiful. I love it. Thanks for your time, brother. Appreciate it as always. And the guys, definitely reach out to him. I know I am. I want to screen in porch, and I don't want to come out of the money with it. So I'm definitely
there you go. There you go. Well, I appreciate you having me.
Thanks, buddy.
All right. Take care.